Tom Bowley, Chief Market Strategist here at EarningsBeats. Good morning and welcome to this Thursday, May the 9th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. Kind of interesting this morning. I don't know if you saw initial jobless claims really jumped. The expectation was to come in around 209,000 claims, which is about what we've been at for months and months and months on end, it seems. But instead, we jumped up to 231,000, which was kind of surprising. Immediately, the 10-year Treasury Yield dropped this morning. Futures reversed. Futures were down overnight, and they turned a little bit green. I'll take a look at those here in just 1 second. But it's interesting because it's almost like traders are hoping for a poor economy, or at least for things to start to head in the wrong direction, so that maybe put a little bit more heat on the Fed to cut rates. But no matter how you slice it, we did see a little reversal in the market. So let me see where those futures are right now. Because overnight, I know at one point, I believe small caps were down more than 0.5%. Might have been worse than that. That was just what I saw. But first up, the diamonds. Diamonds, actually right now, diamonds are down about 0.1%. The spider, actually flat. And the QQQ showing a little bit of strength, up 0.07%. And then the IWM performing best of all right now, up 0.25%. But everything was red probably an hour ago, maybe a little less than that. But it seemed like things turned a little when the 10-year Treasury Yield dropped. Recently, I don't know, I feel like it's been a little bit more of a boring market, which I guess sets up better for the bulls. Normally, when you get into a boring market, you don't see a whole lot of action during the day, maybe just like a little steady climb. That's basically what we've been seeing. We've seen that VIX, the volatility index, drop back down to the lower teens. And when you get back down below 13, we're not quite there yet, but if you go below 13, that's when the stock market absolutely performs its best. That's the history. So as we get closer and closer, I know it was just a couple of weeks ago, we had the VIX up around 20, closing in on 20. I was very nervous personally because I know what happens when the VIX goes through 20, but we never made it. We got up through to about 19.5 or so, and then we turned back down, moved lower, and that fear has been coming out of the market. And we've certainly seen improvement in U.S. equity since then. But let's go ahead and get into this thing. Let's start with what happened on Wednesday. So we've got, there we go. So we've got the Dow Jones Industrial Average. I'll try to make this a little bit larger for everybody. Hopefully this will show up a little bit better on your screen. Anyway, the Dow Jones Industrial Average up 172 points. That was up a little more than 0.4%. But you can see this was actually a 6th straight day of gains for the Dow. And back up above 39,000. Remember, we haven't gone above 40,000. We got close to 40,000 back at the end of March. And then, of course, April was the big selling month. Got all the way back down to 37.6. And now we're back above 39,000, closer to our all-time highs than we are to the April lows. So we have made some progress here over the last few weeks in our major indices. The S&P 500, similar. We did actually finish just slightly lower yesterday, losing 0.03, which rounds to zero. So S&P 500 finished pretty flat on the day, but it was down at the open and battled back throughout most of the day. Same goes with the Nasdaq. Nasdaq was down early on. We were down just below 18,000, I think. Worked our way back to 18,085 at the close, which was still down 6 points, down 0.04%. Mid caps took it on the chin a little bit more, falling a little bit more than 0.25%, but it too was down more at the open, and then we rallied back. And same goes for the IWM, which saw a drop of almost 0.6%. But after opening down much lower than the other indices, got down to the 50-day moving average, we bounced right off of it, finished with another hollow candle. And these hollow candles, the strength at the end of the day, again, that's what really triggers that rising AD line. So we got a little bit of a pop here. You can see even on the IWM, which lost 0.6%, the AD line actually went higher because we did see that strength throughout the day. And the AD line only looks at where you close relative to where you trade during the day. So it completely ignores the gap down. That's the major difference, one of the major differences anyway, between the AD line and the on balance volume, the OBV. OBV, it doesn't matter if you finish down fractionally like the S&P 500 did, minus 0.03%. All of the volume is negative in the eyes of the OBV. It's all bad. We could have finished on the S&P 500 down 4%. It still would have been the same. It's just the volume is considered negative or bearish volume because you finished down that day. The AD line ignores the gap and simply looks at how did you trade during the day? Did you trade back at the high of the day? If so, all of the volume is added. If you traded and finished at the low of the day, all the volume is subtracted. If you finish somewhere in the middle, then it's a fraction, but the volume is the multiplier. So if you have a big volume day and you finish on the high of the day, that's what's going to drive that AD line the most to the upside. And obviously heavy volume selling, finishing on the low, is what would drive it the most to the downside, which to me makes a lot more sense than the OBV. I mean, again, all the volume gets subtracted whether you finish down 1 point on the S&P 500 or 100 points. It's still all the volume gets subtracted. So I don't know. OBV to me personally, I think is misleading. I think the AD line is a better tool. And if you like the OBV, that's fine. I would just have the AD line on there as well. And I'd be more interested when they both confirm if you're an OBV fan. Personally, I don't look at the OBV. Transports down 12 points. That was down about almost 0.1%. Keep in mind, transports are 15,000, so 12 points really isn't a big deal. But once again, not really a big lift in terms of the AD line. We saw just a little bit of movement to the upside. It was heavy volume, or at least increasing volume on the transports yesterday. And we did finish above the midpoint. That's why we're getting a little bit of a tick to the upside in that AD line. But technically, we still got issues here. And that's much more important to me on the price chart than what we're seeing on the AD line. AD line is weak. But the price chart, I mean, we really need to get through this triple bottom. Technically, we've gone through intraday, but we've struggled to close above it. We've still got the 50-day moving average to deal with. This one just, to me, seems like it continues to be the weakest of our major indices. Utilities. And by the way, the transports give us a little bit of a signal anyway, about what we should be expecting in terms of our economy. So it's interesting when you look at the initial jobless claims this morning beginning to jump. Now you got a couple of things maybe scratching your head about, well, what might be happening here in the economy. Trust me, the Fed's looking at this, and they're looking at the CPI data and a lot of the inflation data coming out, and they got a decision to make. I mean, you don't want to give up going after inflation. You don't want that to get away from you. I think they would love to start cutting rates as soon as they can, but they've got to be comfortable, whatever that means in the Fed's eyes. It used to mean a year and a half ago, it meant they just wanted to see inflation start to roll over. But we've seen it roll over and go from 6.7%, and I'm talking about the annual rate of core inflation, core CPI. We've seen it drop from 6.7% down to where it is now, 3.8%. I mean, if that's not heading in the right direction toward 2, I don't know what is. But they've continued to use different language as we've moved through this stretch of an inflationary period. And so it really is up to the Fed at this point, obviously. Do they see enough evidence that inflation is coming down and is more under control? Because as soon as they feel that, you're going to see a rate cut. And I think some of these economic reports, the way transports are trading, I think some of that certainly paints that picture to me. Utilities gaining over 1% yesterday, continuing to move higher, back up over 70 now. This has been a nice stretch for the utility group. I talked about this back in March because March was a good period historically for utilities. But after pulling back the first half of April, we've got even a stronger stretch going right now with the utilities. So don't really have a whole lot to say. I mean, we're sideways consolidating in the market. And as I mentioned, I think in yesterday's show, what this picture doesn't show is how weak utilities were for a year leading up to this period of relative strength. So you're not going to just absolutely tumble on a relative basis forever. At some point, you're going to get bounces, and that's what we're getting clearly on the XLU. Financials up about 1/3 of 1%, a little bit more than that yesterday. But that little move to the upside did take out the bounce that we saw back in April. That was the first bounce. We went back, put in a higher low, and yesterday we broke out above that high, that reaction high, which now means we have a higher high. So little subtle strength showing in the financial area, but hey, we'll take whatever we can get at this point. Real estate down about, well, almost 1 full percentage point. This was again the weakest area of the market. That's been, I feel like I sound like a broken record sometimes, because real estate has been weak on a relative basis for quite a while. You can see we've been downtrending in 2024, while generally speaking, the market's been going up. So real estate, not a very good area of the market. I do notice, though, over the past 3-4 weeks during this rally, look at the volume. The volume has picked up. We really haven't seen much of an improvement in that AD line, though, and that's what I'd really like to see. The volume would be nice, but if you start finishing closer to the highs of the day, we would be seeing that AD line moving up, and we're really not seeing that. So maybe mixed signals at best on real estate right now. Looking at the industry groups from yesterday, these are not necessarily the best performers. Just a couple of interesting comments I wanted to make. So first, we got the telecom equipment group. So we had a day where the market kind of rallied all day long, but technology's leader was telecommunications, basically telecom equipment. And I'm kind of looking at this thinking that's not really where I want to see leadership in technology. And I think that just underscores the boring nature of what I've been talking about. We're not really seeing the massive moves. I mean, semiconductors have done better. Software's improved some, still on a relative basis weak, but not really seeing big moves that are, grabbing our attention. Telecom equipment, though, did make a big move above its 50-day moving average. So I wanted to point that out. Banks rebounded, not only rebounded, but after moving off that April low, kind of been in this bull flag. So we had a flagpole kind of going sideways. Well, we broke out of it yesterday and moved back to the upside. And we're not far at this point from that late March high on the banking group. So banks continue to be a very strong area of the market on a relative basis, and they're closing in on what could be another high. So I still like the banks in 2024, the balance of the year, and I really like those smaller banks, but we've got to get closer to the Fed announcing that they're going to cut. I think once we get there, I think you're going to see the smaller banks do much better. Of course, the one wild card is how bad does the economy start to roll over before we start seeing these rate cuts. So it's going to be a real balancing act for the Fed, continuing to be. They've been trying to go through this balancing act for the last few years. But it's going to be very interesting in 2024 because they really, in my opinion, do need to start cutting rates for the economy. Toys. Wanted to bring this one up because toys has this weird affection for the month of May. I mean, toys haven't been a great area of the market for a long time, but for some reason, this group loves the month of May. And I'll show you a seasonality chart a little bit later in the show. But here you can see that push back to the upside, and where the real strength came in was the first 5 days of May. First 5 trading days of May, this group went up about 6%. Yesterday, lost almost half of it, though, back down near the 20-day moving average. So the big question with this one, to me, is the run over, or was yesterday selling a great opportunity to join in or jump into a group that loves the month of May? I think for me, it's going to be whether or not we remain above that 20-day. I'm okay with the group as long as we do that. But what you'll see on this chart is a downtrend and what appears to me to be a left shoulder over here, left side of a neckline. And hopefully you can see this. But the left shoulder would have been back in March. And then we rallied back maybe in the second week of April, put in a high. That would have been the left side of the neckline. We went back to a lower low, which would be the head. We came back, put in the right side of this neckline, right at about 1,050, and now pulling back into what could be a bottoming head and shoulder. Well, this would be the right shoulder of this potential bottoming pattern. Now, you don't get confirmation until you get that breakout above the neckline. But knowing what we know historically about this group and knowing that this pattern is setting up, and also knowing, I mean, I'm still bullish the market down the road, longer term. Short term, I'm maybe neutral to slightly bullish right now. But further down the road, I am clearly bullish. I want to make no mistake about that, because I get questions from time to time. Tom, you used to be bullish and now you're talking bearish. I'm just switching from my long-term hat, which is we're in a secular bull market. No mistake about it. That's what we're in. To my short-term hat, where we do have a few issues that we're trying to work through. Market went up 25% in 5 months. I mean, let's give it some room to the downside. It doesn't, I mean, we'd love for it to go up every day, but that's not the way the market works. And quite honestly, it's not healthy to be going up every single day. Eventually, that was the biggest problem going into 2022, is that we had a run of 115% higher in the S&P 500 in 22 months. That's what people forget about 2022 and that cyclical bear market. We're up 115% in less than 2 years. Our normal average annual return is 9%. So over 2 years, we normally would look at about 18%. We were up 115%. So you got to keep all of that in perspective. Anyhow, getting back to toys, if I am right, the market's going higher, absolutely this could be a bottoming head and shoulder pattern. So I would say until we lose probably the left shoulder, which would be down around 1,010, 1,015, I'm probably okay with this group. But again, I'll show you a chart on that in just a little bit. Let's move on to the 10-year Treasury yield. Let's get a quick update here, see what's going on. I can tell you, though, that if we look at the intraday chart, you can see this was 8:30. So this is when we got that announcement out on the initial jobless claims jumping. And you can see shortly thereafter, a big drop, a lot of money rotating into the bond market, and we saw a big drop. But since then, we're kind of coming back up again. So, this big drop, I think, kind of spurred the IWM. Remember, we've had this inverse relationship going on. And when we've seen drops in the yield, that's when the IWM seems to do its best. And then when the yields are moving back to the upside, the IWM small caps tend to struggle a little bit. So now that we're rising back up, I don't know. We'll take a look at those futures again in just a second. But the IWM may be pulling back as a result of that. I don't know. But the short-term uptrend is now in play on the 10-year Treasury yield. You can see that after going down for probably a week, or maybe a couple of weeks, we have reversed back to the upside, and it now looks like we're turning until the market tells us otherwise anyway. If we go back below yesterday's low, which was around 4.475, moving back down below that level might start to turn the chart back over again. But at least for now, I'd probably respect this short-term move back to the upside. S&P 500. So let me go give you these futures again, just see if they've changed much as rates have gone back up. The diamonds now are down a little bit more than 0.1%. The spider is up 0.1%. QQQ, which tracks the Nasdaq 100, up 0.14%. And the IWM has pulled back just a little bit. It was up 0.25% earlier. Now it's up 0.2%. So it has pulled back some, but still futures doing okay. Better than what they were doing overnight. I can tell you that much. All right, S&P 500, maybe still trying to finish off this right side of a cup. Maybe we go into a handle for a little while. I went through a few patterns yesterday I thought we could be looking at, so I won't spend time doing that again. But I'm always looking off of an uptrend for a continuation pattern, a bullish continuation pattern to begin to form. And so when you do pull back, I mean, it could be a cup, it could be an inverse head and shoulder, it could be a triangle, it could be a bullish wedge. I mean, there's a lot of different patterns that could develop. And that's what I'm kind of watching for, because it could give us an early leg up on the next rally if we can spot that pattern. So that's why I spend the time looking. Nasdaq 100, very similar chart. Again, hollow candle. Let's pull this up so you can see that hollow candle yesterday right there. Opened on the low, didn't close on the high, but we certainly had a nice move back. We did move into positive territory yesterday on the Nasdaq and nearly took out the high from the previous day. So pretty good action, even though we finished down on the session. Down doesn't always mean bearish. Down, there can be different variations of down. Same for up. If you have a huge, 300-point opening gap to the upside on the Nasdaq, and then you only finish up 40 points. Yeah, you finished up for the day, which is good, but doesn't feel very good after you open up 300, because then you had selling all day long. Not exactly what we're looking for. Anyway, IWM probably underperforming a little bit the Nasdaq and the S&P 500 here over the last 5 or 6 weeks. Just looks like it's a little bit further away from that high that was established. But again, part of that has just been the fact that we had the interest rates jumping, and you can see that took a big toll on the IWM. Now that the rates have settled back down, we're starting to see a little bit more bullish action on the IWM, and we'll continue to watch that. Transports still really struggling to get through 15.4, 15.5, maybe even throw 15.6 in there. That's where the 50-day moving average resides. So until we get something definitive, I want to see a big hollow candle making a break through all this area of resistance. And that wouldn't mean we're out of the woods. It would just kind of flip this bearish narrative that's been kind of associated with transports for the last several weeks. All right, let's move on to the chart of the day. The chart of the day, for those of you who don't know, we do these 3 times a week, Monday, Wednesday, Friday. If you go over to EarningsBeats.com and you haven't already signed up, you just scroll down and there is the form where you can fill out your name, email address. This is a free newsletter. We do this, to try to provide the community with some value. I know that there are a lot of folks out there that can't afford our service. We still try to provide education and some additional stock picks from time to time whenever we can to benefit those who are not paid members, just to get a sense of how we approach the market. So, if you're starting to learn about technical analysis, I think this is a great newsletter to help you along that path. If you're already, a seasoned veteran and you like trading and so forth, I think some of our techniques and our approach to the market will really help you in your trading. Anyway, wherever you are, I think it's a pretty good deal, especially the fact that it's zero. It's obviously it's a good value. At least I think it's a good value. If it's a bad value, don't tell me. Actually, I'm kidding. If you don't like it, I would love to hear from you. But anyway, I think it's a great tool for a lot of folks to get better and to learn more about the market, because the market is always changing and we have to change with it. We have to learn new things every day. I wake up every morning thinking I'm going to learn something new about the stock market, just because it changes so much. And nothing is, even though things repeat, they don't exactly repeat. There's always something a little bit different. And so keeping your eyes open and remaining objective is really important in approaching the stock market. If you want to try our service, 30 days for free. Right now you can click, up here, you can click on this no cost trial, green no cost trial button. I always say it's a great time to join, and I believe that. I always believe it's a great time to join. But what I will say is that we are getting close to kicking off our spring special, and that is our best deal of the year. So if you come in now for a no cost trial, check out our service. If you do like it, during your no cost trial, we will have a really nice special, our spring special out, which can save you a lot of money. So now truly is a great time to check us out and see if you enjoy our service. And if you don't enjoy it, hey, nothing lost. You won't hurt my feelings. I know services are different. Every trader is different. I know all services don't always match with every type of trader. But for today's chart of the day, I want to show you that seasonality chart on the toys. So here is toys. Now, this is just going back 5 years. But does any particular month stand out over the last 5 years? I mean, I'm looking at May, which has gone up every year of the 5, including this one so far. And it averages going up 5.4% for the month over the last 5 years. Now I'm going to stretch it back 12 years to cover this entire secular bull market, which began back in 2013. If you look back over the last 12 years, we are up 11 out of 12 years during the month of May in the toy group. 11 out of 12. That's pretty strong. And you can see there are a lot of other months that really struggle. Look at the average. I'm going to zero in. Look at that average gain in May and compare that to any other month. 5.8. You got January 2.5, July 2.2, December 1.8, and everything else really not very good. Well, March was 1.5, but May just kind of stands out like a sore thumb there, right? I mean, 5.8% average over 12 years. And you see it taking off again this month, although yesterday, like I said, was a down day. And that's why I brought it up. It's like, is this a great opportunity? Or is it time maybe, with that move back down to get out? Seasonality says stick with the group through May. We'll see what happens. All right. I wanted to go through the 11 sectors with you, and I'm just going to look on an absolute basis, not on a relative basis. I just want to look at the charts. Where's our key support? Where's our key resistance? So what I do is I just glance. I mean, when I first look at a chart, I am just looking like I see this low right over here. There we go. I see this low right here as kind of a big low on the chart, at least from a short-term perspective. I also see that those recent highs. So I'm looking at XLK as being in an area of consolidation. Do we go higher or lower from here? I don't know. I don't know. We had a negative divergence, slowing momentum. We've seen it, we've been going up and down below and above the moving averages. And that just tells us it's trendless right now. The key here is, do we break out above that level or do we break down beneath this level? Because if you break down, then you're going to start looking at, okay, what about this level? Okay, what about that level? What about this gap support over here, right in here? You see what I mean? I mean, you start looking for the next area of support and so forth. Well, right now, I'm not worried about all those other levels of support. I'm just worried about what's going to happen in this sideways consolidation. Because now, not only have we seen a reset on the PPO back down to that center line, we actually saw us move all the way back down, put in a new recent low, taking out that double bottom right there. That was back in January, February. So I think technology still is in a bullish. I mean, if you look intermediate, clearly we're still going up. If you look long term, we're definitely going up. And so I'm looking for this short term to resolve itself to the upside. But I'm not going to be ignorant to the chart. I mean, if it breaks down, that would be something that would be more favorable, obviously, for the bears. Technology represents about 28, 29% of the S&P 500. So if this group breaks down, we're going to know. It's going to take effect. It's going to have an impact in the overall market. All right, XLY, and I'll go through these others quicker. That was just one that I think is really big. No doubt in my mind, you can see the bottoms coming in here on the XLY, right at about 170, 169. That level needs to hold. We got a double top at 185. That's where we're looking there. XLC, put in that low on the gap down back in late April. I think that's a key area to watch. Probably also this low over here back in late January. So I'm going to say probably just below 76 up to maybe that 76, 75 area. That would be kind of a range of support I'd watch. Recent high, maybe around 83 or a little above 83. That's your resistance. Next up, let's look at industrials. Industrials, triple top up at 126. Clearly, that's resistance. Downside, you can see a couple of these tails coming down almost to 120. And then in late April, we've closed down near 120. So that's your key area of support. We've had a couple of lows since late April, or since, I don't know, what is that, maybe April 19th. We've had a couple intraday lows down near that level. So I'm going to say 120 to 126. And we're sitting right now at 124. So in the middle of this area. XLF, whoops. Financials, that's where I was just showing that breakout a little bit earlier, getting back above that maybe around April 23rd 23rd, 24th high right in here. We just took that out, which was good, but we've obviously got our top just above 42, our bottom down around 39.5. Which way do we break? Let's move on to healthcare. Healthcare, a little weaker, still trading below the 50-day moving average, but we have moved back up. Clearly, we've got double top up near 148. We got a lot of lows just around 138 or maybe even slightly below that level. So I'm going to say just below 138 up to about 148 is your range in the XLV, and we're in the middle of it. How about Staples? Staples actually made a breakout. PPO is rising. I think right now for Staples, I'd be watching the rising 20-day moving average because you have an uptrend in play. Got a breakout and an uptrend. You can see multiple bounces off that 20-day EMA over the last couple of weeks. So we are seeing some strength in consumer staples as we consolidate, which isn't totally unusual. But yeah, this group to me looks like it's trending higher. How about XLRE, real estate? Pretty weak. The recent highs got double top, triple top, just around 40 or a little bit above. The April low down around 35.75. That would be the range for me. XLU definitely moving higher on an absolute basis, breaking out, very similar to Staples, just stronger. So I would be watching that rising 20-day. If we drop back, hit that rising 20-day, I'd look for support there. How about energy and materials? And we're going to wrap this thing up. We got energy moving all the way back down to the 50-day. I do like that tail recently that went down below the prior support. And what I'm talking about, if we zero in here, see that hammer and this long tail went down below these prior lows, and then we came back up. So clearly 92 on a support basis, on a closing basis, 92 upside, maybe around 98.5. Last one is the XLB. And XLB clearly has a top established with a negative divergence. That top came in around 93.5, put in a double bottom around 88, and we're in the middle of it. So most of our sectors are sitting in a range. We have a couple of sectors, staples and utilities, both defensive groups, that are showing a little bit more relative strength. Now, if the stock market goes back up and we break to new all-time highs and we're still being led by utilities and staples, I'm probably going to be a little bit more nervous about that move to the upside. So that's something to think about in the weeks, days, weeks ahead. If we go back up and we set an all-time high and we're still talking about utilities and consumer staples leading, that would not be a good look for the market. All right, let's take a quick look at what just happened at the opening bell. We're 2 minutes in. The Dow's down 43. We got the S&P 500 up 3, Nasdaq up 25. So on a percentage basis, not really a whole lot. Small caps only up 0.1% now. The S&P 600. We were looking at the Russell 2000 earlier. So let me see what the IWM is up now. Up 0.13%. So it has been coming down since since the beginning of the show, when we saw that futures were up about 0.25%. Now it's up about half of that. Anyway, that's all I got for today. I'm heading to the Wells Fargo today once we get all these storms out of the way, because we got a lot of storms coming through. There were some nasty storms. Anyone living in the Tennessee area or maybe even in the Carolinas, praying for everybody, making sure that everyone's safe, because those storms woke me up in the middle of the night. They were some pretty big storms. I know I heard something about apple size hail. Apple size. I didn't know they had a size bigger than golf ball, but apparently they do. Apple size hail coming down in some parts. So we've got these storms coming through here over the next day or two. Actually, I think it's supposed to clear out a little bit tomorrow. But anyway, be safe outside if you're in the path of these storms. Have a great day, everybody. Be back next Tuesday for your next Trading Places Live. Have a great day. Happy trading.